So Jesse, you publish the Felder report, and you also host at the podcast Super Investors. Welcome to the Judgment Call podcast. Thanks for coming here.
Yeah, thanks for having me, Torsten. I'm glad to be with you.
Hey, absolutely. You know, when I looked at your investment philosophy, it's something you describe that's firmly grounded in what Benjamin Graham and Warren Buffett are doing, called value investing, right? And it's something that seems to be under siege. It's very difficult to find companies with low PE ratios. It seems like everything is already overvalued. How do you deal with this? How do you find investment opportunities?
Well, yeah, I mean, I think the thing that really originally appealed to me about Ben Graham and Warren Buffett's philosophy is the margin of safety concept. That when you buy something at a discount to its fair value, that you're really limiting your potential downside. I mean, I really like the idea of you can buy a dollar for 50 cents. If it turns out your analysis was wrong and it's really only worth 50 cents, then how much really did you risk? And by the same token, if you can find things, to buy at a 50% discount, when the market comes around to your way of thinking, you can double your money, without having a fundamental change in the business. And so I do think, the only areas of value in the market today are, and this is probably true regardless of, the time that we're talking about, but are things that are outside the purview of the most popular strategies of the day. So I think, you mentioned my podcast. I started my podcast about 4 years ago. One of the first people I talked to was Steve Bregman, who's done a ton of work on looking at, passive investing's impact on the stock market in general. And, he was one of the first people to kind of draw attention to the idea that in order to find value today, you have to look outside of what the indexes are doing. The stocks that have kind of been, for whatever reason, left behind, that don't have good representation in the indexes. So that's actually something I've started doing in the last few years, is looking at, different stocks, and then how many ETFs or how many indexes are they represented within? Because you find things that aren't well represented in the indexes, and that's typically where you can find value. So another area today, I think one of the most popular areas or strategies might be ESG focused type of investing. And so, last fall, I was just pounding the table bullish on the energy sector, because this is one of ESG has just taken in so much money in the last few years, and it's just going exponential. And, I think across the board, you see most of these strategies, shun traditional energy. And so those stocks got incredibly cheap last fall, and I think they're still very cheap. And that's really one of the only areas where we've seen, a significant degree of insider buying, with, a guy like Harold Hamm, who's was buying Continental Resources stock, his company stock, just hand over fist last fall, and saying, I'm going to continue to buy $10-20 million, a week, a month, as long as the stock stays here. So yeah, I mean, those are the types of things that I'm looking for. But you're right, they're few and far between.
Yeah, I mean, from what I understand, you're a contrarian, and it's good to have those. And the question is, are we? And I consider myself a contrarian too. Are we just there to kind of watch the circus and kind of rein in the complete craziness? Because when we look at the stock market, and maybe I'm too young to really know much about it, but when I look at the last 20 years, what happened in the stock market, it seems to be this trend following. We go where the trend seems to go from one sector to the next, and it never stops. And the extreme seems to have gotten more extreme. That's, I don't want to sound like an old person, basically says everyone is crazy. But that's how it seemed to me, as an investor, the buying opportunity that I was waiting for, and it was March last year, right? I was like, well, it's went down, but the real economy is in doldrums, so it should go down even further. But my buying opportunity never arrived. So is that something where you feel like we ended this like a super cycle, and we are all just going crazy for a while, and then people will forget about stocks? Or no, we have to redefine value investing?
I don't think, we need to redefine it. I think the problem is the way that it has come to be known in the last 10 years. And I think you make a really good point that there are so many different systematic strategies at work in the markets now. And whether it's short volatility or factors or any of these things, you see them just go and they start working, and then they attract more capital, and it becomes a self-fulfilling positive reinforcement cycle until it blows up, like we saw Volmageddon blow up in early 2018. I think value has come to be defined as a factor, and that's really not how Warren Buffett ever considered it or wrote about it, or even Ben Graham. I don't think you can look at value as a factor and truly call yourself a value investor, because investing, just the definition of investing, the way I think of it, means you have to analyze on an individual security basis whether your principal is protected and whether that security is going to generate a decent rate of return. That comes from Ben Graham, and there's really no way of doing that, I think, on a factor basis. You can't look at the 10% cheapest securities in the market and say my principal is protected if I buy the 10% cheapest price to book value or what have you. And so I really do think, as a factor, value doesn't really qualify as value investing in the way that Ben Graham and Warren Buffett have defined it or laid it out. And so I think that's really the failure of value investing over the last 10, 20 years. Is you look at that cheapest decile of the market today, the 10% cheapest, however you want to define it, and it's more expensive than it's ever been in history. So if you are relying on value as a factor, then you are buying yes, the cheapest decile of the market, but you're still spending the highest valuation for those securities ever in history. And so I think to truly be a value investor, you got to look. You can't use it as a factor. You have to look on a security by security basis.
Yeah, there's someone like Mike Green makes that argument that says, well, we are all kind of over invested into the stock market. And what happens is, if the stock market drops, we kind of need the Fed to jump in, because otherwise all our retirement savings are gone. The whole country stops working, right? We entered this enormous deflation. Before, when the stock market would drop down, it had an impact, but it wasn't like that we would all lose 50% of our money, right? But now everyone is in, right? The whole society has bought into stocks can only go up in the long term. We came to this point where the Fed really has no choice. We need to at least have a slight appreciation or no stock depreciation of the stock market, or this American society comes to an end. That's what people put out there. Do you share this? So we kind of have this inbuilt put, and the Fed has no other choice but to inflate out of it.
Well, I think, yes. I mean, the Fed has boxed itself into a corner here with, I think it really, you could go back to Greenspan after the 87 crash, and, that was kind of the, origination of the Fed put, if you will. But I think it goes back to, Bernanke through the financial crisis, and him saying, we are going to do this quantitative easing in order to try and push people into riskier securities, push the prices of those up to try and create a wealth effect. This was, trickle down economics on a monetary level. And, Bernanke was very clear about this, that we want to make people feel wealthier by pushing up the value of assets so that they go spend more, and this should trickle down to the rest of the economy. Now, I started writing about this in maybe 2014, 2013, something that, this creates a problem, that if the stock market ever starts going down, you risk a reverse wealth effect, right? You risk those people starting to feel, okay, well, my net worth is going down now, and now I'm going to, rein in my spending and puts a damper on the economy. And so, the Fed is essentially, but like I said, box themselves into a corner to where they have to, to the extent that they allow asset prices to go down, that, is counterproductive to their goals in terms of wealth effects and quantitative easing. But I do believe that, we are at a turning point here where now the Fed is saying inflation's been too low for too long, and we need to allow inflation to run hot. And now inflation is, by, CPI and things that haven't started, really recording it yet, or, PCE would be the Fed's preferred measure. But all signs point to rising inflationary pressures right now. And the Fed is saying we are going to allow inflation to run hot. If they do that risks, undoing everything that Paul Volcker set in motion 40 years ago, which is this disinflationary trend that was accompanied by falling inflation expectations, and that was those are kind of self-reinforcing also. So it looks to me like there's a real risk of inflation expectations now reversing higher. If that's the case, then inflation will prove to be much more than transitory, like the Fed is saying. And at some point, they'll be forced to start fighting inflation again. And that's the point at which, the Fed is going to be faced with, okay, if we raise interest rates too much, the markets will crash. Maybe if we raise interest rate at all at this point, the markets will, discount rates go up and asset prices have to fall. And so the Fed will, be forced out of this, supporting the market at all costs by inflation. So, we are approaching, all of these things are coming to a head, I think, very soon. And so it's very interesting to watch.
Yeah, I have the same impression. And I mean, we talked here on the show quite a bit about the old zombie companies that are being supported by the Fed, right? Because we have these extremely low interest rates, but they go to, obviously the idea is that they go to ailing companies to make life better, but the reorganization might have been a better idea. And, they've also gone to tech, which doesn't need 0% interest rates. They would be fine at 15% interest rates, right? And the question, I think, is, we've seen this scenario play out for quite some time now. Japan has been printing trillions for quite some time, for 20 years. We haven't seen crazy inflation until now. Why do you think that is? Is that because it all went into these asset bubbles and they absorbed all that money? I find it staggering that, as an entrepreneur, we see all these 0% loans or 0.1% loans. I'm like, are we really having such low expectations of the future that we basically just expect to get our money back? And it's probably destroyed by inflation, by some inflation that was always there anyways. Where did that all come from? That seems to be not an economic strategy that makes any sense. It's not efficient asset allocation.
Yeah, I think there are. Obviously, the inflation question is the main question facing the markets today, and it's confounded all of the top PhDs at the Fed for a very long time. So but I do think to the difference. We didn't have inflation coming out of the great financial crisis because it was all monetary policy. It wasn't fiscal policy married with monetary. And so we were just seeing quantitative easing, which is money that obviously just went into the markets. It didn't really make its way into the real economy. Today, I think we're seeing something dramatically different, where fiscal policy has, really taken the lead, and monetary policy is just facilitating fiscal to a degree. I really do think we're already seeing modern monetary theory at work. I do think there was a change in monetary policy that we saw back in late 2019, well before the pandemic, when the Trump corporate tax cuts led to rising deficits during an economic expansion for the first time, since the 1960s. And I think that increased Treasury issuance was not being absorbed by the market very well. I think, probably most of it was being absorbed by the basis trade hedge funds, which were, borrowing, in the repo markets in order to buy tons of, Treasury bills. But as soon as they couldn't borrow in the repo markets, we saw, things start happening, crazily. And the Fed had to step in and basically rescue the repo markets. And to me, that was the point at which the Fed had to start funding the government directly, because there wasn't the natural demand to soak up all this new supply of treasuries. So then we lead into the pandemic. The federal government decides to spend trillions of dollars to support the economy, and the Fed has to ramp up the printing presses because there's just, like I said, there's not the natural demand. And so that to me is a clear shift towards fiscal dominance, where the federal government is saying we are doing X, and the monetary authorities have to do whatever it takes to support fiscal. So that is a huge shift, and I really do think it risks, undermining faith in the dollar, faith in the independence of the Fed. All of these things that we've taken for granted for so long, really since Paul Volcker established Fed credibility 40 years ago. And I think it's why we see money pouring into cryptocurrencies and all these things, because everybody, who pays any attention to this kind of stuff immediately realizes. I mean, you look at M2 is, the money supply is screaming higher. And so all of these things point to inflation. And I think that was a change in late 2019, and it's only gotten much more serious, more significant of a change towards fiscal dominance, in the, whatever it is, 2 years almost since then.
Yeah. Just so people understand monetary and fiscal. Fiscal is the policy of the government, right? When they hand out money, that means fiscal. So we hand it out through unemployment benefits or whatever means they find. And monetary is when the Fed changes the way they set interest rates and the way they, QE was kind of, we reduce interest rates even lower. No, we actually wanted to bring them up, right? That was the idea of QE.
Well, quantitative easing was, ostensibly to support, to prevent longer term, to support the bond market, but also to lower the risk-free rate of return and to create this wealth effect, like I said. So I think, Bernanke and the Fed thought if we go buy up, longer term, whatever it is, 5-year, 10-year, 30-year treasuries, we are going to, as my friend John Hussman calls it, you create a hot potato type of scenario. So whoever was holding those treasuries now, has cash, and they don't want to hold cash because there's money printing going on, and I can't go reinvest in treasuries because yields are now too low. So what do? I have to go buy corporate bonds, junk bonds, equities, those types of things. So that was, I think, quantitative easing in the wake of the financial crisis. I think it's not so much quantitative easing today to try and create a wealth effect. It's if the Fed doesn't buy this many treasuries, interest rates are going to go up because there isn't the natural demand for these securities. And so I think it's a change in tone that we've seen over the last 18 months, really in Fed policy. Yeah, we're talking about monetary policy, Fed policy on the one hand, fiscal policy, or what the Treasury is doing, the government and the Treasury are doing on the other hand.
One argument a lot of people make, and I had Edward Tanner on, we kind of went down that rabbit hole. We have more and more industries that kind of get eaten by software, right? They get eaten by technology. We say that software eats the world, and it happens, right? And one of the economics of software is you create a product once, but you can sell it or you can use it basically for free billions of times, like what we do with the Google index. Literally, it's hard to create and it's expensive. But once you do have it, and it's like AI has the same characteristics. Once you do have the solution to that problem, it's basically free for everyone. You can give it away. So we have all these internet business models that basically rely on giving things away because it's so cheap on the long tail. But if that happens to all kinds of industries, we now see, I just looked today at a company in Oakland that does housing, 3D printed. So it's prefab 3D printed houses, really cheap. Well, if you get the land cheap, not happening in San Francisco, but it's happening a little bit outside of Oakland. And once you take that software effect to more and more industries, isn't inflation gone forever? Because prices cannot rise because you only create a thing once and then you can use it a billion times.
Well, that might be true for those software-based companies, but I think if you look at most of the companies that are coming public today, which we've seen a huge surge in IPOs, there's only, software can only, make up so much of the economy. I think what we're seeing today, this is one of the trends that's created disinflation over the last 40 years, is the trend towards globalization. We have become, less a manufacturing-based economy here in the US and become more of a software-based, services-based economy. The way we've been able to do that is by shipping all these manufacturing jobs over to China and things where, the jobs are much cheaper over there. But now part of this inflationary surge that we're seeing today are these supply constraints. And a lot of those supply constraints have come from the fact that we've switched to, just-in-time manufacturing, no inventories, and shipping, jobs overseas. So this is creating all of these supply constraints we're seeing today, and really, turning people against these types of supply chain management decisions that have been made. I mean, I think we saw that when we were trying to get, PPE for, to deal with the pandemic. There were shortages of everything, and masks and whatnot, because we couldn't make these things in the United States, and we stopped making them a long time ago. And so I think, yes, if we were to continue to just shift towards services and continue to be able to shift manufacturing and things, overseas, then yes, that disinflationary trend could probably continue. But what we're seeing today is auto companies are probably a really good example, right? There's shortage of microchips. So they all have to shut down manufacturing. So what are they doing to deal with that? Well, they're talking about bringing manufacturing back home. They're starting to stockpile microchips. They're trying to do everything they can to, and it's really a reversal of this just-in-time manufacturing to now where they're hoarding. Now they're realizing, okay, maybe shipping all of this production overseas is not such a great idea. And so to the extent that we're going to shift from globalization to deglobalization or reshoring of labor, reshoring of manufacturing, that is a shift from a major disinflationary trend to an inflationary trend. And I think that's probably something that a lot of companies are realizing, and not just companies, politicians are realizing. Semiconductors are potentially a national security issue. We cannot afford as a nation to have all of our microchips and semiconductors, produced overseas. And so I think we're seeing a lot of push, both politically and from the companies themselves, to produce microchips again here in the United States, and that's probably representative of a lot of other products that we need, physical products that we need. And so, to the extent that shift is happening from globalization to deglobalization, I think that represents a major inflationary, paradigm shift.
No, I know where you're getting from, and I think it's definitely a political desire to. It's kind of, you think about Germany pre-war, right? It wanted to make sure it can source all the materials it needs for a war that wasn't even on the drawing board yet. In Germany's heads, yes, but nobody else knew about it. So I think this is a political desire, and we, especially with China and the US, we see that. But I think the economics haven't changed. So when you build a chip plant, literally building the chip plant is expensive, a few $1 billion, but then you just need electricity, you need sand, and you need a bunch of people, not even that many. You can literally every chip is free that you make. Well, the first chip is the most expensive, but every other chip after that is almost free. And what I found stunning, and obviously we have the semiconductor shortage, which it's difficult to plan this stuff, right? Because you setting up these major investments, a few $1 billion, and creating the plan, you can't do it overnight. It takes a few months, at least, probably a couple of years. But I found it stunning. I had Brian on the show, and we were talking about hardware startups, and he's like, I was under the impression never do a hardware startup in Silicon Valley because it doesn't scale as well. The margins are crappy. You don't want to be in that place. He said, yeah, well, that used to be true. But I went to China and I told him I want an iPad because he has a device like a picture frame that is from 2 years ago, right? It's not the newest iPad, but it's basically the same thing. No touch screen, so it's a little simplified. And it used to be $600, right? Or $700, whatever the iPad was. And he's like, no, you know what it costs now? It's $20. So it came from this, and I mean, you can still use and buy, go to Craigslist for an iPad 2 years ago. It is cheaper, but the massive deflation of that technology made a product that he thought is going to be all hardware and has no margin to be basically has huge margin. He could give it away for free. $20 is nothing in just a software product. So what I'm trying to say is, yes, software has a limit, but so many sectors are now touched by software and are getting better, more efficient. We see this in healthcare, or at least we're hoping for it. I don't know if it's actually going to happen. And then suddenly, you can, it's like 10x cheaper or 20x cheaper. Like it's an enormous amount cheaper that you reach once software runs through an industry, and we're hopefully going to see it with driving. And that's what I'm trying to say. Like when we think of inflation, it's 2%, maybe 5%, but actually we're talking about 10x, 20x. And if this rolls through all the industries that we are hoping for, well, it hasn't happened yet, but construction could be next. Then we're looking at a house that used to cost $1 million. You can now have for $100,000, and you still make a healthy margin on this. So that's what I'm trying to change. All these economies are changing fundamentally, and this is in motion. And political will or economists can't really do much about it, right? Because it's already in motion. Do you share this, or you feel like this is overblown? Technology is overhyped.
I don't think it's overhyped at all. I think it's fantastic, and obviously it has been. Technology has been an important, disinflationary force. And yeah, absolutely. I think it's exciting to see, the innovations and all those things. And I'm a huge believer, and in it in every aspect. But I do think we're also seeing, these, let's just look at EVs, for example. We want, politically and for the environment and things, we want to shift from, traditional combustion engine vehicles to EVs. Now, in order to do that, if we want even, a third of the cars on the road to be EVs over the next 10 years, the demand for copper is going to go up tenfold. And there's just, there's no way the demand's going to go up tenfold without the price going up at least that much. And so I do think, to the extent that, these technologies and things are going to, be very important to how we evolve as a species over the next, several decades. There are the limited, supplies that we have, in terms of commodities that we're dealing with that can end up undoing some of the, the benefits of the software. So I think it's super complex issue, of course.
Yeah, I talked with Orbis Zubrin about his book and asteroid mining, and he's like, well, asteroid mining obviously makes a lot of money because it's almost, we're at that stage where we can go there and bring it back, and it makes money if it's full of platinum and gold. But here's the problem: once we bring that much platinum or gold back here, then the price of gold will be very different, right? It will be $100 instead of $2,000 just because we have so much more supply. So it's not that easy just because we can find more supply. It's kind of with oil, right? Every 10 years is this, we're going to run out of oil. And then 10 years later, we're like, oh, well, we found so much more oil because it was slightly more expensive and technology improved. And now we can run this for another 100 years or so, right? The oil reserves seem to always just 10 years away from depletion. And then 10 years later, we're like, oh, actually it went up. And the demand also went up. So something is strange with this, right? Forecasting these demand curves is extremely difficult.
Yeah, absolutely. And I to me, the best use for these forecasts is for sentiment signals, right? Because it was, 2000, about 10 years ago, they were predicting, peak oil. Like you said, we were gonna run out of oil at some point. And very recently, a year ago and less, there was a lot of talk about peak fossil fuel demand, that we've already reached, peak demand, and that we're going to be awash in a surplus of oil, from here to eternity. And to me, that was a wonderful time, 10 years ago to say, hey, energy stocks and things are probably overpriced. Oil price is too high. Once you get this buy-in, everybody believing that, peak oil is a thing, that is a sentiment signal, that the bullish sentiment towards traditional energy has gone too far, and vice versa. When you have everybody believing in peak demand because EVs are going to take over the world in, the next, 10 years, that to me is a terrific signal of that the bearishness towards traditional energy has gone way too far. So yeah, those things those forecasts probably best used as sentiment signals, I think.
Yeah, that's a good idea. Well, what do you think of, my grandfather always talked about that idea of free energy, right? We have whatever technology, obviously it was nuclear fission at the time, but that's the way we have technology has changed. But clearly we are limited in space exploration. Whatever we do on this earth by generating electricity is still kind of in the Stone Age, so to speak. It's not that much different than it was 100, 200 years ago. We blow up slightly different things to do that, but it's still very inefficient, it seems. Do you think there is a big revolution coming, that we bring energy prices way down, right? That's the big innovation. It's still energy, but the kilowatt hour will drop, I don't know, equally by a factor of 10, or we will see them slowly rise, because like in Europe with all the green revolutions, they've risen a lot. They're probably 3, 4, 5 times what we pay in the US.
Yeah, I think, the thing that I really pay attention to in those in those sectors, and in basically any kind of commodity based sector, is however much capital goes in, the returns in that sector go down. And so, yes, the more we're pouring a ton of money today into green energy. And so the investment returns are going to go down, but also the cost, of, I think that was one of the things we saw. It was wonderful, result of the dot-com mania and the internet bubble, was so much capital went into building out the internet that investors lost their shirts, right? I mean, we saw the NASDAQ, go down 90%. Over, a 2-year, 3-year time frame. But, there was so much fiber optic cable and things that were laid that, ended up being a wonderful thing, for the internet, even though it was terrible for investors. And I think that's probably the same thing we're seeing with the green revolution today, is that, everybody wants to invest in, these EV companies and green energy and all this kind of stuff. So there's tons of capital going into the sector, which is going to be a good thing for the economy, because it's going to bring down the cost of that, energy production. but it's not going to be a very good thing for investors because there's just too much capital chasing it right now. Conversely, right now, like I was mentioning ESG, and the popularity of it is really starving traditional energy of capital today. And what that necessarily means, in my view, is that traditional and the price of oil, natural gas, these things are probably going to be much higher, 3 to 5 years from now, because we're not investing. It was just the exact opposite of what happened in the wake of the financial crisis. So the wake of the financial crisis, we had the cost of capital came way down. All of these fracking companies were able to borrow, money so cheaply and invest in, shale oil in the United States. And it really created a huge boom in oil production in the United States. So what happened? So much capital went into the industry. The price of oil crashed in 2014 and has been essentially crashing since then because too much capital went in, too much investment. I think what we've seen over the last few years is the opposite, where there's been almost no investment in building out new energy sources or even the existing shale sources over the last 2-3 years. And what that's going to mean is the price of new green energy is going to come down, while the price of traditional energy sources are going to probably go up over the next 3 to 5 years.
Yeah, that makes a lot of sense. When you invest as contrarian as you do, how do you get the timing right? I guess for a lot, and myself included, it's really difficult to see these manias develop, right? You see, you have this fear of missing out, and not just the fear, you're really missing out. We just saw it with Dogecoin. I had a bunch of Dogecoin, sold it, and now it's like 10x. I'm like, oh my gosh. That's difficult in the social environment, especially if it's driven by daily news, or if we have this Twitter phenomenon, and it involves us emotionally. And when you are so contrarian, I know you have to wait out long cycles, maybe 5 years, maybe 10 years. How do you deal with this, that nothing happens to your investment or no catalyst happens and everyone else is enjoying a 10x? Isn't it really difficult?
It's not difficult. I mean, I think a lot of people don't know that, I was buying Bed Bath and Beyond, last year at the March lows at, $3 a share. And it was just like GameStop. It went up tenfold, in January. And so, GameStop went up, whatever it was, 100-fold, something like that. So yeah, if you were looking for those types of opportunities, they're out there. But you raise a good point that, in being a contrarian and being a value investor, you're at danger of, being on the wrong side of the trend, right? Things that are out of favor can continue to stay out of favor and get more out of favor, and vice versa. If you're looking to short sell, and you're looking to sell things that are, have a good momentum to the upside, that you really need to pay attention to precisely that, the momentum, because I do think, 15, 16 years ago, one of the best things that happened to me, I met Tom DeMark, who you've heard of DeMark indicators. Tom has, for the past 25 years, he's been essentially on staff with whoever's run the biggest, most successful hedge fund at the time. So he's essentially been on staff with Paul Tudor Jones or Steve Cohen or, whoever it is has been. And that's because he has come up with some brilliant ways to study momentum and trends, and really to help time these turning points. And so his TD sequential indicator is one I use across multiple time frames to look for trend exhaustion. So I look at typically monthly and weekly time frames. And that's very helpful when you get clusters of signals across different time frames, that can help you understand when a trend might be nearing its end and reversing. And by the same token, it was maybe a couple of years ago, 3-4 years ago, I met Michael Oliver, who's another just fascinating trader who came up with maybe 30 years ago a way of isolating price momentum and looking at momentum, specifically charting momentum and looking at momentum structures. And, that can be very powerful too. And I think when it doesn't take a genius to look, and when you see momentum gaining and, increasing, that's not, a sign that the trend is near its end. It's a sign that the trend is very strong and probably very near the middle of a trend rather than near the end. And what you want to look for, in these trend reversals are signs that, these types of exhaustion signs, that DeMark signals can be helpful with, and then also signs of waning momentum. So, back, with energy, I think, peak downside momentum was several years ago. We had, like I said, the oil price crashed in 2014 and has had several, more, price declines. But last year in March, when it had that, pretty deep decline, actually oil prices went negative. What was interesting was that momentum was not, continuing lower along with prices. And so that to me is a very bullish sign when you see, market participants pushing prices to new low, but momentum is actually starting to improve. And so downside momentum is not quite as strong as it was. Those are the types of things I look for to say, okay, now it's safe to maybe start getting interested in this area, because the downside momentum is waning, which is kind of an early sign that that trend might be ready to reverse higher.
Yeah, that's really smart. And I guess buying oil when it was negative was another smart call. Hopefully you got in on that trade. It was only for a few hours, I think.
Well, I don't trade the commodity directly, but yeah, I mean, like I said, a lot of these oil and gas producers, became, very, very cheap last year. That's why, Carl Icahn was buying Occidental Petroleum. And like I said, Harold Hamm was buying a ton of continental resources last fall. Those are the other signs that I try and look for too, is, really smart insiders that are saying, no, Jesse, you're not an idiot. Your idea of value here is, we're validating it too. We're putting our own money where our mouths are.
Yeah. Yeah, I got into oil too. Probably way too late, but it's good since then. So I'm really happy about it.
Yeah.
What you wrote this note and I read it. It's don't ask me about Bitcoin. I think what you wanted to say is, and it was received highly critical by the Bitcoin bulls right out there. Pump is one of those, and we see that on one hand we have all these political feelings that people associate with Bitcoin, for better or worse, right? And the founders of Bitcoin, Satoshi apparently had that too. It's this liberal agenda of freedom, of we can control our own currency, we can do our own, set our own deflation or inflation rates, and not just like the Fed, who kind of does it in a weird Soviet system that nobody knows how it actually works. It seems to be very random, or maybe needs to be random. And on the other hand, there is this strange accumulation of Bitcoin prices, which seems like a mania to everyone from the outside, maybe not from the inside. It probably looks still way too cheap. And I think what you pointed on, that was really interesting. You said, well, we only look at one Bitcoin, but we don't look at all the forks and all the other cryptocurrencies. Most of them are not doing anything. They don't rise up 100%. Only very few do. And that's the one we hear about when we read Elon Musk tweets.
Yeah, I think I probably was a little insensitive when I wrote that. I didn't. I guess what I probably should have expressed is I have a deep sympathy for the sentiments that are behind the cryptocurrency boom. I think absolutely. Like I mentioned, the reason cryptocurrencies are booming, I believe, is that everybody recognizes the money printing for what it is and realizes they desperately need to protect themselves somehow. And so I absolutely agree with those sentiments. The major problem that I have with cryptocurrencies and Bitcoin included is this, store of value and scarcity argument. That's the part of it that I just don't buy into. Like my friend Diego Perilla has said, supposedly there's only going to be 21 million Bitcoins ever mined, but there's 21 million cryptocurrencies potentially that can be created out of nothing. And there are several risks related to that. One is that it seems like Ethereum, lately is dramatically outperforming Bitcoin, and that could be because the Ethereum blockchain is potentially more efficient and a better platform than the Bitcoin platform. So there is this risk, this idea that potential that Bitcoin is the MySpace, and along will come the Facebook, which will essentially make Bitcoin obsolete. There's also the risk, that, and I do believe this is a much bigger risk than people, give it credit for. I mean, every central bank on the planet is already talking about and planning a central bank digital currency. And there's no way that central banks, will ever give up seigniorage, and that is, the ability to print and control the currency and profit from the creation of currency. Obviously, it costs the Fed nothing to create a dollar out of thin air, and it's a dollar of essentially profit to the central bank when they do that, and they're doing it to the tune of hundreds of billions of dollars every single month. 120 billion to be exact. And so, yes, I do agree people need to protect themselves from that. I just think that, the way to do that historically through 5,000 years plus of history is to invest in real assets. And I don't consider cryptocurrencies real assets. I consider only real things, real assets like real estate, commodities, gold, and these types of things. And so for me, cryptocurrencies don't fit into that framework.
Yeah, I understand where you're coming from, and I feel like I never understood when I first heard about Bitcoin back in 2013 why it is so bad. I thought when we have an internet-based currency, and that was always missing from the internet, right? We had PayPal, and PayPal was kind of going this way, but had a really struggle in the beginning to make this work because there was so much fraud in the system. I always feel if we find an internet currency, then it should behave like the internet. It should be immediate, 200 milliseconds maybe or less transaction times. It should be fraud free, and it should be very easy to use. And Bitcoin is the opposite, right? It's a thought model, and it works, but it has nothing to do with what I want out of a transactional currency. So I completely rejected it, but that I think is now being fixed, right? That's finally coming in with a new generation of cryptocurrency because it got so much effort, and it was always more like a bug than a future. It wasn't supposed to be slow, but on Bitcoin, you can easily wait an hour for a transaction, even if you pay a really high fee. So it's 3% transaction fees. It takes forever. There's no real-time communication. I'm like, what is this, right? So obviously it's because it's decentralized, and that was difficult to pull off when it was created. But it failed the mission that it set out, but it created, for whatever reason, that political spark. And I think once we see now we fix those problems, and I think Ethereum too, and Dogecoin especially, they fix all these issues. So maybe it's a bit like the internet, right? So we actually think it's something, but then we put all our money in because we know it's a short thing, and then we realize, oops, it wasn't a real thing. And actually, some people, the technocrats in that industry, they built the real, plumbing, and then it worked out, and something great comes out of it. I think this is what I think happens with Bitcoin too. The original mania will go away, and it will all drop 80-90%. But in the way, something really beautiful is going to happen, and that's hopefully what we always wanted, right? It's this real-time, unlimited, and not controllable a currency system, which I think it's a real problem. I mean, we have this amazing amount of privacy intrusions, and just blocking someone from making transactions is so easy. You literally call MasterCard, Visa, and Amex, and then you're off, right? You're dead. You can't even take an Uber anymore. And that's not how it's supposed to be. And when we have an independent currency, or at least an alternative currency, we would fix that problem. I think there's a lot to it.
Yeah, I mean, I think I would just take issue with one thing that you said, which is, all of these transactions can be monitored and actually blocked, on Visa, MasterCard, and things like that. And you said that's not how it's supposed to be. Well, that's not how we would desire it to be. But I think that's the way that sovereign governments want it and will always require it to be. You look at what the Chinese central bank digital currency intends to do. What it intends to increase the surveillance of the populace to a degree that they've never had before. And I think other central banks are looking at that and saying, yes, a central bank digital currency gives us so much more control. But I am very excited about the underlying technologies. I think, one of the things I've heard proposed, obviously recently in the wake of the, Robinhood fiasco during the GameStop, craze in January, was that, we could settle, stock trades, trades of kind of anything, using some form of the, the blockchain that might potentially be able to speed up, so that we don't have, 2 or 3 day settlement like we have anymore, that we could settle, in real time. Would be a very exciting way to utilize the technology. And there's a myriad of, potential ways to use it like that.
Yeah. Anything that's I think if you find an application that you don't want, you don't trust the other person to fully control it. And I think payments is one system, but there's free speech, there's all these things in our daily life where control has gotten so cheap, right? Before it was always controllable, right? I grew up in Eastern Germany, and you could control the population, but it was expensive. So at some point you just gave up. And you're like, okay, let's have people. They have a satellite dish, whatever. They can watch some other country's TV, which was a misdemeanor at the time. But at one point, the enforcement was given up because it was just you don't want to go hunt for satellite dishes. There were no drones or helicopters. It's a lot of pain, and so they just let it go. But I feel like what we now see, we have the enforcement of all these technology laws is so easy, right? Google can just drop your name, and it takes them a second to do it, and you will never appear on Google again. I mean, I think that's where all this crypto comes in, is that it's independent. I think it's the level of enforcement, how easy it's gotten. People underestimate that. In financial markets, but also anywhere that's touched by software, enforcement is like push of a button, unless people come up with a layer that kind of hides the facts from that software, but it's getting increasingly more difficult.
Yeah, and I mean, I've been, I deleted my Facebook account in 2012, 13. I stopped 3-4 years ago using Google search and using Gmail. And, it's one of the reasons why I had Roger McNamee on my podcast, a few years ago. He's one of the first investors in Facebook, and really brought it up to Mark Zuckerberg and Sheryl Sandberg, the how this company was kind of changing from truly a way for people to connect online into something that more sinister. And, really the creation of the surveillance of economy in over the past few years has been something that's very disheartening in my personal opinion. And and so I've looked for ways personally to kind of remove myself to any without too much effort, but it was a lot of effort to stop using Gmail and so a lot of these services. It's it takes effort. And so absolutely, I sympathize with the desire to create these independent platforms, and I do think that it would be a wonderful thing to be able to decentralize a lot of the world of finance. I mean, and tons of these other industries. I just think that the desires of the people to decentralize are directly contradicted by these big, powerful platform companies, which make a profit on centralizing, and who are also have a lot of pull in the political systems around the world. So I really applaud it, and I'm for it. It's just it's definitely an uphill battle.
Yeah, I want to talk about something else. The investment world, the way you see it changing. We know that banks are basically, with crypto, maybe their business model is definitely threatened. We know that even investment banks are really threatened by just computer algorithms, right? So there's a lot you can do with algorithms and AI. You still need a few people designing them, but you don't have to have that same manpower. How do you see the financial world evolving? What's like this major disruption right now? One thing that I just noticed is for companies like Brex, who's a sponsor of this show, they basically just they encoded anything that like a business bank account would do, put it in some piece of software, and now it's just running wild, right? So there's no additional people that they necessarily need. They obviously need some customer service assistants, but all this stuff you usually would do at a bank, it's all now encoded in software. How is the financial industry really responding to that?
I think they're absolutely responding to it. I think all the major banks are looking at how to utilize blockchain. I think what another thing maybe people don't appreciate well enough is the Federal Reserve is owned by the largest banks in the United States. To the extent that those banks are going to be cut out of any area of their purview in the world of finance, they're going to be lobbying Congress, and they're going to be lobbying Jerome Powell to prevent that from happening. And so I do think, yes, we are probably going to see a lot of these technologies implemented by the major banks, but it's going to be on their terms. they're not going to be cut out of lending and all of these trading and all these things. They're going to find a way to implement blockchain so that it serves their business model. I think that's what we're seeing, and I think that's really the purpose behind this central bank digital currency that the Fed, is looking into now. It'd be something to preserve the fractional banking system and preserve, the power of the central bank to control the currency.
But isn't that like a university, an offline university competing against online universities? Yes, they might have, a bit of runway, but ultimately they're doomed for 99% of the students. Some will remain and some will find it worth the money, maybe the Ivy League, but all the other universities are doomed basically on a cost factor basis, because you can give the knowledge out for free and still make some money off subscriptions. Isn't it the same what's going to happen to most financial companies right now? They can obviously resist it, and they will use all the political tools, but at some point they're out of money.
I think that's true in a system where you don't have a sovereign power that sees it in its interest to prevent people from utilizing a new system. There's been a problem with, the fractional banking system has been problematic, for a long time, right? We have to the extent that we deregulate the financial system, we get more financial crises. That's just history. The more you let Wall Street and the big banks do whatever they want to do, the more problems there are for society. So regulation is extremely important in all of these things. But in your analogy, we're talking about online, education versus in-person education. I do believe, the future is moving online. But in that scenario, you have an all-powerful sovereign entity that's going to say, to the extent you want to disrupt this, we are going to make that illegal. And I do think that is a risk to the DeFi movement, is that whatever is going to disrupt the central bank, and the central bank, that means, the fractional banking system, whatever is intending to disrupt that will be made illegal. That's just my belief. You'd have to create a new sovereign entity that believes, DeFi is the foundational.
But some country will, right? So there's always one country who will say, okay, this is all good with us.
Yes.
They will go with it. And how do you actually enforce it? I mean, all you need is like a debit card, and then you can access your money in, I don't know, Estonia. And it's very difficult for the US to enforce this unless they really want to go down to the lowest level and check, where did your money come from? It's possible, but it's really intrusive. I don't know if we really want to do this, because the benefits are obviously huge. I agree, we will see more volatility. If you make this all DeFi, people will go crazy. Volatility will rise up for sure.
Yeah, no, I guess it just comes down to a philosophical belief, which is, you could look at it like and I hate to make this comparison, but with the attack on the Capitol, right? There are people that wanted to disrupt our voting, system and our political system, and create it, and rebel against that. And there's no way the federal government is going to just sit back and say, okay, we're going to, allow you guys to create a new voting system or a new political system that completely disrupts and dismantles, everything that we've created for 200 plus years. I just don't see that, that happening. A sovereign entity is never going to allow its power to be undermined. And that's just my belief. But we've totally ventured outside of my area expertise and just got into philosophy.
We'll come back. That's okay.
Okay.
I was curious about it's a bit abstract, but it's coming back to the financial world. Do you think information is becoming less or more valuable? And I'm asking this because I see. You run a newsletter, right? You sell information, but you also invest based on this information. But we've had this rise of information is well, there's this theme that we say, well, it's becoming more important because we have more leverage, because there's social media, you put the wrong information out there, and then we immediately influence the whole planet. But on the other hand, we also know that people now realize, oh, it's fake news, and there's lots of stuff, and there's like these systems are complex. So information may be becoming less valuable because there's so much noise around it. So it's impossible for the outsider to figure out what is actual noise and what is real value, what real information I should put some value to. Well, how do you feel about this? Do you think information, especially in the financial world, is becoming more important or less important?
I definitely think information is becoming commoditized, and I think that it is becoming less valuable. What I do think is becoming more valuable is thinking, the actually thinking about this information. Because I do think, like we see it with algorithms in the markets all the times, right? A headline will hit, it'll come across your Bloomberg screen, red highlighted thing, and the market will algorithms will automatically just, react and move prices. And a lot of times those movements are, ridiculous or, and undone in a period of time. So I do think, we are outsourcing a lot of thinking right now, whether it's, to in the market, like I mentioned before, to these systematic strategies. And I think, what happened with GameStop and Bed Bath & Beyond is a wonderful example of this, where I do believe a lot of these short-based hedge funds were essentially creating systematic strategies for hedging. I mean, for selling short, these stocks. When I was looking, one of my part of my thesis for buying Bed Bath & Beyond was not just the stock was incredibly cheap and momentum and things started turning positively, but also that, like similar to GameStop, almost 100% of the float was sold short. Now, as a short seller, I mean, I was a co-founder of a hedge fund firm back in the 1990s. We had a short-only hedge fund. There's nobody in their right mind, when you think about it, would ever sell short a stock that has almost 100% of the float sold short, because the risk of the market going against you and just not being able to cover your short is way too great. And we saw that with Melvin Capital get absolutely caught on the short side, being short GameStop. But more than 100% of the float was sold short. So clearly nobody who was short GameStop was doing any thinking at all about the risks involved with shorting GameStop. And I do think that's just representative of so much that is going on, not just in the markets, but, beyond. I think, we talked, a little while ago about passive investing. How many people are thinking about, what Mike Green has been, talking and writing about, with the risks that are created, the risk to financial stability by the popularity of passive investing. And almost nobody is thinking about these things. And so I do think, yes, information has been commoditized and actually has become devalued because it's become so easily accessible. But at the same time, I think we're doing a lot less thinking about what that information means, how to use that information. And we're kind of outsourcing a lot of thinking to algorithms across a lot of industries. And I think that creates opportunities, creates problems, and creates opportunities for people who really do want to do the thinking about, how these things really could potentially play out.
Yeah, I remember these stock screeners, right? When I think they were very popular with value investors, where they basically look at the balance sheet and what's the growth rate of that company. But I think when we what you just described is basically the layers of screeners that people have for their decision making, right? Kind of like we go, and I always compare this to GPS, right? When we go somewhere new, we always trust the GPS. If we go somewhere where we kind of know the route, and we would rather stick to our own route very many times. And I think this is, we've explored the risk. I think we know what risk means in that subsector of thinking, and then we make better decisions than the AI. And I think this is going to be the big battle over the next 30 years, is to stay ahead of AI. And for this, you need to be extremely focused, and you need to be lucky maybe sometimes, but you need to get ahead of these algorithms that are on a different decision-making algorithms that other people use because they don't know enough, and they use it and apply it. That's obviously more abstract than it should be, right? There's edge cases, kind of when you make a new law, it's always an edge case where it doesn't really work. And then you what do? You just give it to a judge or change the law. It's now never perfect. I think this is what we all have to rise up, that we become this pattern recognition animals aided by AI, and then we just have to get better and better at this. Maybe that's what we're doing already, but I feel like we now have a better layer to describe all this, what we've been doing for the whole time.
Yeah, and I love that you brought up the example of value investing, because I talked about how value as a factor has taken value investing somewhere where it was never intended to go, and I think outsourcing the thinking about securities to create algorithms that search up screen for stocks or those types of things. You lose what makes value investing valuable in the first place, which is actually thinking and analyzing, the individual securities. And so, yeah, I mean, that can be, I guess, applied to so many different examples, where we aren't doing enough thinking about, things. And I don't get me wrong, algorithms have been a wonderful, innovation in so many areas of our lives. I mean, things like GPS and things that make our lives so much easier that we totally take for granted today and made us more efficient, and productivity's gone through the roof. But I do think it's gone so far that people have become too reliant potentially on them in some areas, and we need to for those of us who do want to spend the time actually thinking about the cost benefit in some of those areas, it can be pretty profitable.
When you think back to LTCM, that hedge fund that went bankrupt in 1998, the first crisis of the Fed, that they tried to rescue everyone with the policy that the Greenspan put. What they described is we're looking for money machines. So literally things they've seen once, maybe in just sub-market, and then they tried to install a machine. And one of the bets was the European interest rates convergence. But they were so short to bet $1 billion on something they back tested it, right? But it wasn't a long-term data. They had, from what I know, I haven't been working for LTCM at the time, but what it seemed to me, they really made a calculated bet in the sense of, we know that works, and then we just blow it out of proportion, and then we really just hang on for dear life and hope that it still works. Do you think that's still what's going on in most banks and hedge funds that trade on such money-making machines?
Yeah, and I think probably what happens is, I mean, we're seeing, I think it's called, Gresham's law, which is, as soon as you use an indicator or a metric or something as a target, it loses its benefit as an indicator, because you start, manipulating it. And I think maybe short volatility was a really good example of this, where, if you look through the history of the VIX, you could create a strategy that says, oh, you know what, every time volatility does X and rises by this amount, if you start to sell, VIX futures, you would have profited this amount. But that history doesn't take into account that nobody was able to short volatility during that period. Yeah. So once you start shorting volatility, nobody really realized that, okay, well, selling volatility actually makes volatility go down, which, once it gets big enough, and then that going down, the volatility going down, makes the algorithm sell more, and which makes volatility go down. It becomes a self-fulfilling prophecy. But then, short volatility gets so big that, you start having, just like we saw in GameStop, volatility goes up and it doesn't come down again. Well, then what happens? You start selling more to the point where you're massively short volatility, and if it doesn't go down at that point, then you're gonna be wiped out. It's very similar to long-term capital, and then you're forced to, okay, we're going to be wiped out if we don't start unwinding this trade. Well, now you have such a huge short position that in unwinding the trade, right, you're going to push volatility higher than it's ever gone before. And so, yeah. I think it's probably a very good example of how we look at creating these these strategies, algorithmic based strategies, without considering how the strategy itself, in utilizing it, putting it to work, can create problems. And passive investing may be the next one that we reveals how, okay, we look at the history of you just investing passively over this time period, you've done phenomenally well, but now more than 50% of the market is invested passively, and that's never happened before in history. So what are the consequences of that? And some people are doing some fascinating work and starting to think about it, but we're still not doing enough.
Yeah, one thing, when you mentioned short volatility, the Fed seemingly always makes money by shortening volatility, right? So whenever the Fed goes in and it's being rescued, volatility has spiked up already. Typically, well, maybe it's just in the process of going up. But when we draw a long-term average volatility, like the companies they bought, was it IAG, this big reinsurer that they basically bought it, that the U.S. government bought with the help of the Fed, and it seemed like if you have that amount of capital, and the Fed obviously isn't short of capital, well, there is a limit, but it's a lot. You will always make money going short volatility. When you look back the last 300 years or whatever, thousands of years, sooner or later, this society comes together. At least from what we remember, we haven't wiped ourselves out. Society comes together, produces a certain amount of progress, then we fight a little, and then it just boom, and there's a crash. But I felt like this is the best policy ever. I would be anywhere close to the Fed. I would just go in like the Fed and just shorten volatility in this time of crisis. Vic's description is 40, 50, 60. And this seems to always work. I don't know, nobody ever looked at that.
If the Fed itself is actually shorting volatility to try
to make a ton of money. Yeah, I mean, they are not hurting for money, right? But if it seems like this can't go wrong. I mean, maybe 5 years, 10 years, you might be out of liquidity. You might not be able to hold on to your margin call. But just in theory, I felt this cannot go wrong if you have a 5-year investment horizon.
I think you're right. I mean, the Fed, there is no limit to what how much money the Fed can spend. The only limit that I see is the value of the dollar. That so long as faith in the dollar around the world remains, then the Fed can go spend as much money as they want, print as much money as they want. As soon as that faith begins to erode in the value of the dollar, then that limits the amount that the Fed is able to print, to buy securities, to buy whatever it is, short volatility. And so that's why I've said since, I think January of 2020, before the pandemic, and kind of, it was after that, repo fiasco that I mentioned. I said, the most important chart in the world is going to be the chart of the dollar, because if the dollar starts to break down again, to me, that's the real sign that people are starting to lose faith, and that is really what my friend Bill Fleckenstein has said. At some point, the bond market's going to take the printing press away from the Fed. It may not be the bond market. The Fed might be able to implement yield curve control, and so we're going to print enough money to prevent interest rates from rising across the entire curve. Well, then it might be, the currency that takes the printing press away from the dollar in that scenario. And so that's why, watching the chart of the dollar is probably the most important one. It's been on my radar for, last couple of years.
I fully agree. This is the limit, right? So if nobody buys the dollar anymore, then the Fed printing doesn't make any difference. But here's the thing. It's that there isn't a real big working model out there in the world. I was talking to Pablo the other day, and Dubai is obviously a model for economic freedom, but it's a tiny little speck. It has its own problem. Singapore, Hong Kong, not so much anymore. What I'm trying to say is we need, in order to improve ourselves, we need an enemy, in the sense of it can be a role model. It doesn't have to be someone we go to war with like China, but China is a little bit in that sphere where it become a real competitor. But the US doesn't have enough competitors, and that's kind of my thesis. That's why we have this malaise of low interest rates and low productivity growth. If we would have some real competitors, worthwhile competitors, not like Japan and the European Union who do the same thing and are worse off than we are, in terms of, at least economically, maybe they have higher living quality or quality of life. Do you feel like we have a competitor rising? Because then the dollar would really be in trouble, right? If another economic bloc or another country really figures out how to play this game well, and we're on the losing end.
Well, I do think China is already making steps to try and replace the dollar as the world's reserve currency. Whether they're successful or not will depend on, how people start to feel about investing in China and owning the currency. But it'll also depend on, what we do from a fiscal and monetary side, here in the United States. And, you mentioned, if the dollar goes down, people won't be using it anymore. I think the bigger risk, to the Fed is if the dollar does go down dramatically, that is a sign in the changing inflation expectations, and it creates, imported inflation, right? The prices of everything that we need. We've deglobalized so massively, over the last 30 years, that the value of the level of the currency has become more important than ever. So that if the dollar goes up, that's deflationary for prices in the United States. Dollar goes down is inflationary. And so, as I mentioned, at some point the Fed might be forced to start tackling inflation, would be bad for the asset markets. And so that's part of the reason why I'm watching the dollar too, because if the dollar starts really going down, that means these inflationary forces that we're already seeing are going to be exacerbated by currency-based types of inflation, and an overall sign that people are losing faith in the dollar and inflation expectations are going up. All of those things together create a scenario for the Fed where they have to turn their perspective towards fighting inflation and those inflationary expectations. And so that's why, to me, the currency is the number one indicator for paying attention to those trends.
Yeah, I think you're onto something. One thing do I notice when I travel, I've been traveling over the last 12 months too, because I had to. I feel like the dollar has gotten, at least for now, more valuable. You go wherever you went, it feels like, whoa, it's much cheaper than last time I was here. Like, you remember going to Australia 20 years ago was kind of cheap, and 10 years ago it was like, man, this is so expensive. Breakfast is $40 for one person. And it's not even big breakfast, right? So, but now you go back and it's like, whoa, it's everything is becoming more affordable. That could be because everyone is in distress, but restaurants in the US haven't changed prices much. Maybe a little bit on delivery apps, but in general, I feel like in the US we do have inflation for sure. But if you go outside the US, it feels like there's huge deflation. That might be just in my mind, and economic indicators might not support this, but on anecdotal evidence, wherever I show up, I feel like, whoa, this is only half the price it used to be. These are obviously flights and hotels and food. Colombia is one of those places. Maybe that's because I select them, right? There's places that haven't changed so much, but I didn't have the impression in the last 10 years, even with exceptions, maybe Australia, there's a few exceptions, but generally I feel like whenever you go abroad, the dollar has gotten more valuable. Maybe that's just me thinking that, but that's kind of my impression that I had.
Yeah, no, I mean, there's been a huge dollar bull market for the past 10 plus years. I think I can't exactly remember when it was when the dollar bottomed. It was kind of in the late 2000s there were these terrific sentiment signals when Jay-Z, filmed a music video where he was, throwing wads of euros in the air, and Giselle, Tom Brady's wife, said that going forward, she will not allow anybody to pay her in dollars, only euros. And that was kind of at the end of a big dollar bear market that began in about 2001 and lasted 8 or 9 years into 2009. But right at that time, when we saw Jay-Z and Giselle, saying euro, 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 the dollar bottomed. And since then, it's had a huge run higher, especially in 2013, 14, 15. We saw a big run higher in the dollar. And that's one of the reasons why the Fed, wasn't forced during the last cycle to really raise interest rates a ton, is because that ended up being a disinflationary force with the rising dollar. So now, dollar really peaked back 2015, 16, and to me, has been, potentially entering a new bear market. And so if that's the case, and the dollar breaks down again, I'd be curious to see if the dollar breaks down again, below late last year, early this year's lows. That would be the sign to me that, okay, we're entering into, this is a new dollar bear market, and that is going to put additional pressure on the Fed on top of all these other inflationary pressures they're seeing already.
Only have one last question for you. If you can draw as a worst case scenario, obviously we've been talking of opportunities and risks, and it's not all negative, but if you feel like this Fed policy is coming to an end and we're entering a new paradigm, if you're having much higher inflation, a lot of people think about stagflation right now because economic growth stays low too. Are we talking about the stock market maybe loses 80%? There's a broad market decline? When you look about maybe not worst case, but worst case realistic scenario that you would expect for the next couple of years? What are we talking about? Is it inflation 10% or inflation 100%?
It's impossible to forecast. I just think that, the Fed is saying we want inflation above our 2% target, and I think they're going to get it. I think we might see, CPI, hit 5, 6, 7% over the next, few months. More importantly, we'll see core inflation, pick back up, and that's without food and energy prices. Whether that affects the markets or not, I don't know. I think it depends on, really what the Fed does. I think that's what everybody's looking at. We saw Janet Yellen, this week suggest that interest rates might need to go up, and that spooked the markets. And so that's just kind of a signal that's literally what everybody's paying attention to. When is the Fed going to start talking about tapering? When are they going to start talking about raising interest rates? Because that's really all that matters. Now, in terms of risks to the stock market, I wrote a piece today, or just published a blog post today that showed, the traditional, Buffett yardstick, the market cap to GDP for the United States is 30% higher today than it was at the peak of the dot-com mania. So what that means is stock prices would need to fall 40% overnight to just be as expensive as they were at the peak of the greatest bubble, the widely, acknowledged greatest bubble in modern history.
But it's all tech stocks, right? So that's that's literally 10 companies that will have to fall by 80% would there because the rest hasn't moved that much.
Yeah, I mean, it's the market is all, Apple, Amazon, Facebook, Google. And so, you're going to need those companies to drop in order to see that type of a drop in the market. But something I've been writing about for 4 or 5 years now. And really why I wanted to talk to Roger McNamee is because sentiment is changing. And I think it's a part of this Bitcoin boom is this anti-surveillance economy. We're seeing this now as a bipartisan issue. Republicans and Democrats both believe that these companies have gotten too much power. And when you see, it's almost like, replay of kind of the Gilded Age, when we saw monopolies rise in the early 1900s and then government stepped in to regulate them. And I think that's probably the biggest risk to these companies today. I even read a piece today where California is talking about regulating them like utilities, and basically, limiting the amount of profit that they're even allowed to legally make. California obviously can't do it themselves, but they can tax their activities in the state. European Union's also looking at, taxing the platforms, in ways that limit their ability to profit from their monopoly powers. And so, that's just one of the risks. But from a risk standpoint, I do believe that it's pretty astounding to just think that stock prices would have to fall 40% today just to match the peak of the last major bubble.
Yeah. Well, maybe there is really a better future, and the stock market is just predicting that. Let's hope for this. That would be the best case scenario. Let's see if it happens. Jesse, thank you so much for coming on. Really enjoyed it. It was awesome.
It was a great discussion, Torsten. Thank you.
Hope to see you again.
Anytime.
Take care, Jesse. Talk soon. Bye-bye.
Okay.